Hey everyone, today we're diving into the most powerful valuation tool in finance, the discounted cash flow model, or commonly known for DCF. So, it's a method that investors, bankers, and analysts use to estimate the true intrinsic value of a company based on its future cash flow. So, let's break it down step by step. So, part one, what is a DCF? So, the DCF is all about one simple idea. $1 today is worth more than $1 tomorrow. Why? Because of inflation, opportunity cost, and risk. So the DCF estimates how much a cash company will generate in the future, and then discount that back to today. To find out what is worth right now, it's kind of like saying, if I expect a company to make 100 million in the future, how much would I pay for it today? So now step by step, I will break it down. First, you need to project the free cash flow, FCF. The free cash flow is equal to the cash of a company that is generated after covering operation and investments. To project the free cash flow, you usually start with revenue, subtract operating expenses to get the earning before interest and tax, so the operating profit. You adjust for taxes, you add depreciation and amortization, you subtract from capital expenditure, and then you subtract the change in working capital. And then you repeat this about 5 or 10 years, depending on the company. So after projecting the free cash flow, you calculate the terminal value. So companies don't just disappear after 5 years. So we need to estimate what they will be worth after the projection period. Two main methods for that. Gordon growth method. It's terminal value equal final year of the free cash flow time 1 plus G divided by R minus G, where G is long-term growth and R is the discounted rate, so the weighted average cost of capital. And the other method is exit multiple method. It's applied to a multiple like enterprise value on EBITDA to final year EBITDA. The step 3 is discount cash flow to present value. So now that we have the free cash flow and terminal value, we discount them using the weighted average cost of capital. Weighted average cost of capital reflects the cost of both equity and debt financing. We'll cover this in a future video, but for now just remember that a higher weighted average cost of capital means higher risk and lower valuation. So the step 4 is a sum of everything. So you take the present value of year 1, 5 or 10, the free cash flow plus present value of terminal value, which is equal to the enterprise value. Then you subtract net debt to get the equity value. Then you divide by the share outstanding to get the price per share. Okay, now I'm going to explain you why to use the DCF. So why is the DCF is such a powerful tool? Well, because it's based on fundamentals, cash generation, growth, and margins, not stock market hype. It's super powerful when you're analyzing startups or private companies. You want to understand what really drives value. You want to compare what it's worth versus what the market is paying. However, DCF is also very sensitive. Small change in assumption, like growth rates, margin, or weighted average cost of capital, can massively impact the final result. So, the common mistakes that are made in the DCF, well, overly optimistic assumption, like unrealistic growth, so you need to be careful about that. Ignoring working capital or CapEx, so the capital expenditure. Using outdated weighted average cost of capital or inconsistent terminal value method. Always double check your numbers and run sensitively analysis. We'll talk about that in the next video. Okay, so that's your fully guide to building a DCF model step by step. In the next video, we'll explore how to test your DCF using sensitivity analysis, so you can stress test your assumption and see how much they affect value. So the next video will be about DCF sensitivity analysis and assumption next.